Hey guys, it's Chris Mancola with the Mancola Group over at West USA Realty, and I'm doing our weekly market update. I've been pretty busy with work, and my mother passed away um, a few weeks back, so it's been kind of crazy with you know everything going on. So thanks for all the thoughts and prayers of everybody who's reached out. I really appreciate it. And anyway, so getting into what's going on with the market, I am going to get you up to speed on some of the crazy stuff that's been going on so that you can better understand what I'm looking at and, basically what there isn't to worry about, what you should not be worrying about. Okay. First of all, just to kind of go through some stuff here. Year over year inflation, not month over month, but year over year is actually down, which is really what the Fed looks at. So that's good. Of course, we want it to go lower. And I'm going to get into the whole tariff thing here and all that in a second, and why we have a really good outlook and a great starting point and a launching pad for what's yet to come. Um, we've had sluggish home sales starting off this year because there's been a lot of volatility and stuff going on, but a lot of good things happening as far as what we're seeing with some of the stuff that our government is trying to do as far as spending, which I'll get into here more in a second. But sluggish home sales for the beginning of the year. The bottom line is as of the end of January, and again, keep in mind a lot of this stuff lags. So, at the end of January, there was about 494 new homes available for sale, yet only, which isn't a lot. Sounds like a lot for the whole country. That isn't a lot. Okay. Usually, we'd like to see more coming online, but and increased buyer demand, of course, but yet only 115,000 have been completed. Okay. So those are the homes that people can actually move in now. A lot of these homes that are being built are what are called spec homes. So a lot of them, have, things that, haven't even maybe started being built yet or whatever. They're just dirt, a lot of them too, but that's how many, have actually been made available for people to move into. Pending home sales, you know, are definitely lower than we'd like to see. But I think we're going to see a trend up here really soon because we're coming into the busy season anyway, and the other factors that I'm going to talk about. Case Shiller, now this usually looks a little bit in the past, but prices are still up, and I'm going to talk more about that as we go up, but they've actually been up. And again, this is across the country. December, year over year basis, home values rose across the country 3.9%, building upon November's 3.7 gain. The 10 city composite index posted a more robust 5.1 year over year increase, while 20 cities saw a 4.5 rise, indicating stronger growth trends in major urban markets compared to the national average. So that's a good deal there. So for example, it says here, we can continue to highlight upward trend of home prices nationally. For example, buying a home for 600,000 that appreciates by 4% over a year could result in a $24,000 gain, upscoring the substantial wealth building potential of home ownership. So those are all good things. Now, as far as this whole tariff thing, I'm going to play a couple things for you. I got them sped up here. We have to understand that the only thing that actually causes inflation and the reason why this new administration is trying to rein in spending so much is because number one, most of the jobs that have been created have been government jobs. Many of them have been government jobs. We lost jobs in the manufacturing sector. Our construction employment for new homes and things like that has remained flat. One of the biggest indicators going into recession is unemployment in construction, and that's remained very flat. So we always keep an eye on that, along with manufacturing. Okay, those two things can tell us that we have been or are in a recession, because usually we find out of a recession after it happens, usually months after it happens. We saw this week where the GDP numbers went way down, way down. Okay, so without getting too far into the weeds here, to understand that the thing that causes inflation is government printing money. Okay, too many dollars chasing too few goods. Another thing too, like with the eggs and chickens and stuff like that, as far as that goes, and even beef, we also had supply chain issues with the fact that they've been killing millions of these chickens. I can't get into the details because I don't want to get censored too much online, but suffice to say, there was this bird flu thing. If you have one chicken, the government would come in the past and tell you, you got to kill all your chickens. They subsidize the farmers for that. The farmers necessarily don't want to kill all those chickens, but rather than just taking the one or a few chickens out, they make you kill and destroy all the chickens. This week, there was actually eggs at Costco. A couple of weeks ago, there wasn't. It was crazy. So that's another shock, obviously, to the supply chain and the supply, and the whole bird flu thing and the way they treat that, and giving some of these, let's say, treatments to the chickens, f- play into that, and hopefully that all gets fixed and sorted out, because it's kind of crazy that that's even going on. But that aside, overall, we've talked about this before, regulation like that, energy sector, because it takes energy to, run a business, run a manufacturing business, ship things, all that costs money. And that certainly has effect on prices. And we just saw, just in the last day or so, I saw that, oil came down about 5%. So that's a good sign. Apex producing more oil. That's good. We're opening up pipelines and stuff. That's going to be a positive thing in the right direction there. We're opening up some of the energy sectors and stuff, opening up lands for lumber, and restarting these sawmills, and our offshore drilling. All that stuff's positive. And then, we're still running under the last administration's budget, which was bloated government spending. Okay. So we have to be, kind of adult about this and kind of look at this from all these different angles and understand whether we like who's in office or not at any given time. All those things matter, because again, the biggest the biggest thing that has to do with these inflation factors are these regulations, but also the main thing is, how much money is the government spending? How much debt are we in, and how much are they printing? How much are they spending? And how much waste is there? So those are just pure economic facts. Okay. So that is what it is. And again, we have to kind of, look at what's happening now with these tariffs. And, you hear, well, tariffs are going to cause more inflation. You know, one of the things I'm going to play for you here really quick is this idea of what I was talking about, and also a little bit more in depth on this. So I'm just going to play this for you really quick.
In inflation, if all of a sudden they hit us right back.
Remember, so you made one comment. So inflation comes from a government printing more money. Some prices can rise. This bottle of water.
It can't happen at all.
No, tariffs do not create inflation. Printing money creates inflation. You have a balanced budget. There can't be inflation. It doesn't mean one product could be more expensive and one product could be less expensive. But China, I'll give you an example. China has the highest tariffs in the world. In the world. Everything gets taxed in China, and they don't have inflation. In fact, they have deflation. India, the second highest tariffs in the world, they don't have inflation. So this concept is just people whining and complaining and not being truthful. The fact is, we need to protect America. Why does China tariff everything, and we give them a free ride back here? And they subsidize the opioid production.
Okay, so there's that. Here's a little bit more in depth on this. Keep in mind,
soaring because deficit spending is way too high, money supply increasing. That only tariffs do.
Keep in mind, I don't know if you've been watching the news this week, but you've had a lot of these companies coming in from other areas of the world, like Japan, even Apple, bringing in hundreds of billions of dollars. Chip production, it's coming right here to Phoenix, the Phoenix area. 500 billion, Saudi Arabia is going to be investing $1 trillion. Now, some people don't like other people getting involved, with bringing in foreign dollars for those sorts of things, but it's about bringing back manufacturing jobs and other businesses back here. So we got worried about the supply chain issues during COVID, right? What about, things like pharmaceuticals where China makes a lot of that stuff? We want to bring that stuff back. We want to bring that stuff back because, number one, it's a national security issue. Also, we don't want these, people having to run around doing 2, 3 jobs at a time. We want real high paying middle wage jobs for people. And there's a shift from Wall Street, not that, Wall Street's going to do fine, but there's a shift from Wall Street to Main Street, the smaller businesses too. And businesses, bring in employees and people then are employed. And, we want those higher paying jobs for people. So that's why these things are important. Also, what this guy's going to talk about too is kind of the in-depth stuff as far as tariffs goes and how that relates to bringing in other companies, and also how it brings in how it's not a tax or not an inflationary factor on all products across the board. There may be one slight adjustment in one product for a short period of time, but eventually or right away we're seeing, and keep in mind with economics, with Wall Street, even with the bond market, a lot of this has to do with messaging. It's like just the mere fact that we're starting to offshore drill again and do all these things that the last administration got rid of. We see that there's already a reaction in the markets on those items to benefit the consumer. Okay. So just the mere fact that these things are in motion now, we've got Honda coming in, instead of building the cars in Mexico, they're going to build them here, those sorts of things. We had, like 110,000 car manufacturing jobs that we lost. We were losing like 9,000 jobs a month over the last year in that sector. So, we have to look at, and now we've got an upshot already in the last month of 9,000 jobs. So the messaging, the action, these things taking place are bringing in these other jobs. Now, some of it, yes, may take a little while to get going, but it does have an immediate effect in the right direction for the consumer. So let me just play this really quick.
Do not cause inflation. Inflation is caused by a massive increase in the quantity of money supply growth, and money velocity increasing. That only happens with higher government spending, higher government indebtedness, and more money printing. Tariffs may increase individual prices if the production of the good is entirely made in foreign countries and if demand is inelastic. However, if tariffs are going to make an individual price rise, the rest of prices for the same quantity of money would not go up. In fact, they would go down. Higher money supply growth, higher government spending, and higher indebtedness. That is what creates inflation. Tariffs are also a geopolitical weapon. If we look at the reality of these economies, what we can see is that they have two Achilles heels. Number one, they have very significant levels of industrial and productive overcapacity. Number two, they need US dollars in their enormous trade surpluses in order to stabilize their currencies and their economies. Therefore, the most likely scenario is that those tariffs will be absorbed by the producers. When they have overcapacity, they need the trade surplus, they need US dollars. Therefore, most of those tariffs are going to be absorbed by the producers. These are the major trade partners of the United States. What you can see in red are the two economies that are also the ones that impose highest levels of tariffs on the global economy. It is very important to understand that the United States cannot be the only economy in the world that has open borders, open windows, and open doors, while everybody else is imposing more restrictions. Immigration drug trafficking, people trafficking, the utilization of exports to weaponize the fight against liberal democracies, and so the use of exports to collect more dollars and finance increasingly interventionist economies is something that we need to take into account. Everybody talks about protectionism when it's a Trump administration. However, nobody seems to be talking about protectionism when it's about the global economy. And when we look at global economies, what we can see is the following. This is interesting. Russia, Indonesia, India, Brazil, China, these are amongst the most protectionist economies in the world, the ones that put the highest number of trade barriers and tariffs. So, what we can see is also a geopolitical response with the Trump tariffs. These countries are getting together to try to create a system that, on the financial side and on the political side, opposes the United States and the West. At the same time, they need enormous exports to the United States and the inflow of dollars. So, one of the reasons behind these tariffs that President Trump is announcing is this geopolitical weapon against those that are trying to use their export revenues to change the system and even combat the West. Furthermore, what we need to understand about the European Union is that the biggest tariffs imposed on European Union businesses are made and imposed by the European Union itself. The enormous taxes, enormous trade barriers, enormous regulatory burdens, and the gigantic so-called CO2 tax. All of those are destroying the competitiveness of the industry, agriculture, and farming in the European Union. If the European Union lifts its trade barriers against the United States, which are disguised under the environmental, regulatory, and fiscal umbrella, then there would be no risk of tariffs. There would actually be a partnership that would be successful for both the European Union and the United States. Money supply growth is actually soaring because governments are spending like there's no tomorrow, because money velocity is growing as governments use deficit spending to increase public hiring and also public consumption. All of those elements are the ones that create inflation. If we go to the next graph, what we can see is how the US economy is weakening precisely because of interventionist policies. A massive increase in government spending and government hiring. More than 1.6 million new public employees, government employees under the Biden administration, and much higher government spending. 10% increase only in 2024. $2 trillion more government spending than in 2019. What we can see is that we are going to see strong negative revisions of the job market. That is showing how weak the economy is, because with 1.6 million new government employees compared with the Trump administration, first Trump administration, minus 600,000 public employees, the level of labor participation and employment to population ratios are still below 2019 levels. Core inflation is rising. The PCE index is showing that inflation is back. And inflation is back because government spending is soaring, because deficit spending is way too high, money supply growth is at 27-month highs, and the Federal Reserve decided to change its monetary policy and reduce the normalization of the balance sheet in June of 2024. This is the reason why core inflation is rising. The latest figure of GDP shows declining investment and rising government spending. That is not a good omen for the US economy. What we are seeing is a bloated GDP that comes from government spending, that comes from government debt, which is exceeding the level of GDP creation. And furthermore, this level of investment is now declining. These are not positive elements. That's why the US needs pro-growth, lower taxes, lower government spending, and better productivity enhancement policies. Keep defending freedom.
So, better than I could put it. So I just figured I would show you that. So hopefully that wasn't too long for you. But getting back to the current situation here with the housing market. Okay, so keep in mind we are still under the Biden budget. Those dollars are out there. Those bloated government's still out there. So right now we're seeing a lot of cuts trying to be made to the government, cuts in spending, bringing more external revenue into the country through these tariffs, and in the same time, a pro growth with bringing those manufacturing jobs back into the country, bringing dollars back into our country, and then we again stimulating the economy with energy, and then with this, in about 7 days they're going to be doing their budget as far as the Congress is concerned. So this is where where they make the sausage. This is where the bloat comes from. This is why you pay more for all these things, and you're wondering why it costs so much. Remember when we had the last financial crisis? What happened? Too big to fail. Well, why are they too big to fail? But did anyone help you during that period from the government? Did anyone help you with your foreclosure and, all that crazy stuff that was going on with housing back then? No, they didn't. They didn't. You lost your house, you had to foreclose, people were claiming bankruptcy. You weren't too big to fail. You all the whole thing about, what was going to happen was on our backs on Main Street versus Wall Street. And did that make things better? No, it did not. So we need to get government out of, juicing these things and create an environment where we can prosper. And that's exactly what's happening. Part of that budget process is not only these cuts, but tax cuts. That's the other part. Regulation, energy, tax cuts, okay, and creating more manufacturing jobs. That's the formula. And that's the formula that's going to work. And as a matter of fact, Scott Bessent, the new Treasury Secretary, came right out and said recently that in the next few weeks, you're going to see an explosion in the housing economy, as far as the housing economy goes. Well, we've already seen rates drop basically every week for the last several weeks. Okay. We're at a 4-month low in interest rates. A big part of that is the splits getting better between the 10-year treasury, which I'll get into in a second, at which the 10-year treasury basically should be about 2 points or 175 or 1.75 or 2 points difference between the 10-year treasury and what the average 30-year mortgage rate is across the country. So that happens with stability in the market. Yes, when you change things, there's going to be some volatility, of course. But the issue is, people that are, wanting to try and keep things the way they are. Of course, you're going to have some volatility. So U.S. trade deficit hits record in January. Not a good thing. This is not good for us. This is why we need to have these tariffs. Would it be something if we did have an external revenue service instead of an IRS? There's people in red states talking about no property taxes. These are all positive. Why are they talking about these things? Well, in a lot of the red states, they got hit by national disasters, like hurricanes and stuff. Um, and their insurance prices went through the roof like everybody else's, but even more so where it's even hard to maybe get insured in a lot of these states. Okay. So there's all these things happening. So there's going to be some volatility. Okay. It's like the first time you go to the gym, are you going to be sore after not going to the gym for several years? Or are you going to be like, yeah, I'm back doing what I was doing when I was, hard at it when I was 20 years old, and now you're 50. No, of course you're going to be sore. There's going to be some pain, but that's what it's going to take. It's not going to be like, what you hear on the stupid legacy media where you've got this idea that tariffs equal everything's going up. No, everything's going up by all the government spending, by the stupid restrictions and regulations and higher taxes that we're having to pay and that businesses have to pay. Okay. And so they can't hire as many people, they can't pay as much. So, it's a good thing that we're seeing some of this change as far as what we're seeing in this, this new economy. So the Bessent tries to calm the markets because of this week. U.S. Treasury sought Thursday to persuade nervous investors that Donald Trump's economic policies are part of a larger coherent version. So keep in mind, we've got to get Congress. We're getting Congress in line. So what you're probably going to see in about a week, I think it's the 14th. Congress is supposed to come up. They're probably going to come out with a CR. And we hate CRs, continuing resolution just to keep the lights on with the government. But in September 30th, so there's going to be cuts, coming along that way through the OMB department where they can use what are called impoundments. That'll get challenged in the courts, of course, from the crazy people that want to thwart all this stuff because they were living off the gravy train for so long. That'll get beat down. But we'll have this issue come up where basically they have this idea that you have to spend all the money that's appropriated according to the way it's written by Congress. But the president has this thing called impoundment where he can redirect certain dollars. For instance, the Green New Scam. That money can be diverted back to energy policies that actually work, because all those things are subsidized by the government, and we don't want government doing that because that creates more dollars towards those programs, and that means more money is being spent, being printed for those things, and that's an inflationary factor. Just to give you that one example. So he'll be able to divert things to savings, and bringing in, more of this economic prosperity to get our GDP up. So, like you said here, Wall Street's done great. Wall Street can continue doing well. Best had said on Thursday at the Economic Club. So, in other words, the small businesses, okay, and the middle class need to do better. Wall Street will be fine. They're going to do just fine, okay, as usual. Now, as far as getting to the housing market, so hopefully that made sense. And again, I would say, if you want to put a time frame on it, I don't really like putting time frames on these things. He said the next few weeks. I think we're going to see second to third quarter. We're going to see a big shift, and all we need to do, and we know this just by the last couple of years, whenever we've had rates come down around 6%. The housing application data, the under contracts, all that stuff tells us what's going to happen in the next 30 to 90 days as far as who's applying for home loans, you going out there shopping for homes, getting under contract. That puts us out 30 to 90 days. Those numbers shoot up every time. And Barry Habib, crystal ball winner, 3-time crystal ball winner, who I also follow, he has basically given a forecast. By the end of this year, we should see rates right around 5.8, 5.7%, right in that range. So we only need to get to 6, and that's just the average across the country. You can get lower rates now. You can get buy down rates now, paid for, by even builders. Okay, and that's why the builders aren't ramping up, in big ways. They're building right now is because they're having to pay all these concessions to buyers in order to keep their lights on and keep their businesses going. So as these things come into effect and the spending stops and all this rate of growth increases, we're going to see a huge, as you called it, the golden age. But we're going to see all these things come into place. So this came out today. The head of the United Auto Workers of America just stated that tariffs are necessary to correct years of abuse of the USA by other countries and companies. We have lost $90,000 factories and plants since the beginning of NAFTA. And he's 100% correct. All you have to do is go into the data. I won't bore you with all the data, but 100% correct. I grew up in upstate New York, and back even before my time in the small town I came from Auburn, New York, there were like 40, 50 different factories up there, and it was kind of a nice little town to live in. But you go into those towns like that and all these different places, and they're just gutted out, all these manufacturing jobs, or people are having to drive further to get to other jobs, can't find a job. You see all these areas that are depressed and these things. It's a fact of life. People, the legacy media can tell you whatever they want, but when you go check your pocketbook, that tells a story right there when you go to the grocery store or have to put gas in the car. So all these other things may sound nice, but really, when you look at how it's funded and how it actually works, it really doesn't make any sense. This kind of stuff makes sense. Okay. How nice would it be to get rid of the IRS and not have to pay income tax eventually, and all these things. So one in pending home sales are now this is across the country. One in 7 pending home sales are getting canceled. The highest share during this time of year on record. More home purchases are being canceled, especially in the southeast part of the country. Okay, and again, what's the reason for a lot of that? Well, a lot of that has to do with higher taxes, has to do with higher insurances in those areas, or if you can even get insurance. Texas and Florida have a couple. They're like they make up like 40% of the entire supply of homes, okay, across the country. So, there was a lot going on there in those different places with those natural disasters, and those sorts of things are kind of coming into play with insurance and all that. Rising supply and falling demand, more, but this means more options for home buyers too. As we see more properties come on the market, that's a good thing for home buyers. We got a little bit of sticker shock with the mortgage rates and home prices remain stubbornly high, with January's average rate hitting 6.9. That's obviously down now. And I think today we ended up at about 6.7%. But Trump blames globalists for stock market sell-off. That goes back to what we were talking about with, a lot of these people, are worried because of all this global, shift with bringing manufacturing back here with these tariffs and stuff. And if you go, you can look it up. I'm not going to get into it here, but if you look at, like, for instance, what Canada, we heard what he said about China in the other video, where basically China has some of the highest tariffs in the world, and they don't have this inflationary factor. And when you look at Canada, for instance, how much they charge us in tariffs, it's astronomical. Go ahead and just look it up on YouTube or on TikTok or Google, and it's amazing what it's crazy tariffs that we're paying. And really, we can get our own lumber. Trump's going to be freeing up a lot of the forests and stuff for that. Of course, replacing stuff for anybody who's worried about the environment. But energy, all that we can do that all right here, guys. We just have to lift, get rid of the nonsense and kind of lift that stuff. So all these things don't cost so much. It doesn't cost so much as build with the regulations, and we have our own lumber supplies and these huge tariffs that we're paying for Canada that are killing us. So, when you stop and analyze it and break it down, it makes a lot of sense. Lower the taxes, okay, on everybody. Lower the taxes to bring in more, business, the regulation, the energy costs, and stop spending all the money and stop having the government bloat. So 10-year treasury today, let's see, let me refresh this to make sure we're on the same. So 4.3. Okay. So in a normal market, and the splits are getting better. Okay. Right now we should be at 6.3. We're at 6.7. That's pretty good, because with all this volatility, if we were in what we were in over the last couple of years with the last administration, and remember, we're still living under that administration's budget and spending. We're still living under that. That's why stuff costs so much. The next week, they're going to do a continuing CR, okay, for the budget. That going forward will bring us to September 30th, when the real cuts can come in from Doge and all those other things that we're seeing as far as the government spending on the government and waste, fraud, and abuse that we've been seeing all over the place. And those things are real. Okay. And then we're going to see also a lot of the other spending that we spend on a lot of other things and programs go away. So, mortgage rates right now, I think we ended up at this. Let me refresh this. 6.79. Okay. 6.79, I guess, is where we're at right at the moment. And we have active listings. Finally, we're in the right direction for home buyers. But we see, prices still aren't coming down. Active listings in February were 2.7% higher than the year earlier. Properties under contract right now. Let's see, we were at for accepted contracts versus back on market, we were at 329 over the last week. Okay, so that's basically kind of flatlined a little bit. Let's see. And then, before I get into that, as far as the overall, let me bring this over. Sorry about that. Okay. As far as the overall numbers, we have, let's see if I can make that a little bit bigger for you. There we go. Okay. 76 days closed on market. Okay. 4.3 months supply. That's kind of a normal average uh, market. Um, as far as days at supply, okay, that means if nothing else came on the market, it would take 4.3 months to get rid of everything. Absorption rates a little on the lower end at 20, a little over 23%. The average list price is 780. The average actual sales price is 630. That's definitely up year over year. We were in the fives. And again, a lot of that, can be different in different areas. The list to sales price ratio is 97.8. So we usually like to see that a little over 98, a little over 98%. So whatever it lists for, it's coming in a little bit lower than what the list price is. This week, this is as of March 3rd, we were at a little over 24,000 homes went on market. Pending's down a little bit. Okay. And closed units, we had a little bit of volatility. We saw when rates went down a little bit lower than they are right now, we saw a big surge in application data. We've even seen people refinancing over the last couple weeks because the rates have been coming down about every week. And then closed units are up 13.3%. And that came from that even lower average that we have right now on the interest rates. So the interest rates are going to be key. We're not going to see prices go down because we just still don't have enough inventory. But we would have, I always explain this, when we had the crash, we had like 58,000 homes for sale in the Phoenix area. Okay. Across the country, we had about 4 million. Okay. And right now I showed you the numbers of what they were for, homes coming on market, before for the whole country. Right now, like I said, we've got like, 24,000 coming on the market. And these are all the price ranges, right here and a percentage of properties under contract. The sector that's actually doing really well is our luxury market in the Phoenix area. The 2-year change in annual averages in Paradise Valley are 33.5%, Scottsdale 16.6%, Fountain Hills 15%, and Carefree was at 14.5%. But everything else is around the 6 to 8% range. There's a few in the fives as far as the non-luxury markets. So, our home prices are still going up steadily here in the Phoenix area and pretty close to the usual averages. So that all plays out, the way we would expect, and that all tracks. The Crawford Market Index, that tells us basically where we are, and this gives us a range of 90 to 110 is a balanced range, 100 being completely balanced. Anything over 110 is a seller's market. Anything below 90 is a buyer's market. So right now, overall, because we have more supply than demand, we are actually in a buyer's market at 83.8. All right. And we should start seeing things shift as we're getting into the spring buying season. Okay. And as rates continue to drop, again, there's going to be some volatility. That's just, we got to be adult about it. There's going to be a little bit of volatility. Things are just taking a little bit longer right now to sell, but we're also getting into the busier season. All right. The other thing that tells us kind of the now, well, before I get into that, as far as areas that are into a seller's market right now, where we have Chandler, top of the list, Scottsdale, Tempe, Paradise Valley, Gilbert, Fountain Hills, and Phoenix. Those are all in seller's market, mildly seller's market, nothing crazy. And then we have Cave Creek, Glendale, Mesa, Avondale, and Peoria. Those are all in balanced markets. And our buyers markets, our cities and buyers markets are Goodyear, Queen Creek, Surprise, Buckeye, and Maricopa City. Okay. Um, this contract ratio is really helpful. I think I've explained this in the past a few times, but basically what this does is it tells us really the immediate right now. So how many properties are under contract? Whoops, I just lost the whole chart there. Uh, versus how many properties are listed, and that gives us our contract ratio. Okay, so we really, Chandler. Let me pull that down a little bit more. Chandler right now is in a hot market. You can see the 67 under contract versus the active. Anything over 60 is considered hot. You can see the guide over here on the left for balanced, hot, warm, and all that. There's parts of, let's see, that's Glendale, Peoria, another part of Glendale. There's little parts in there. Part of Phoenix has a hotter market. Everything else is pretty much, in a warm to balance range. Okay, nothing crazy happening. We've got a few colds, in a few of these other areas, but that tells us more of the now, what's happening and what the outlook is. I would suggest to you that again over the next quarter or two, we're going to see these numbers increase. Obviously, just with the normal seasonal stuff, but as rates continue to drop even more with the better splits, getting back to normal on those economic splits between a 10-year Treasury and what mortgage rate averages actually are. And then when we get to the rates actually dropping, we're going to see a big difference there. So, um, you know, one other thing is we're having an open house this week. It's going to be Saturday from 12 to 3. This property is over in Surprise on McCroney Ave. It's listed for $525,000. It's got a pool. It's got a lot of upgrades. Come check it out. It's a 4-bed, 2-bath, 2166 square feet. And it's a beautiful property. And we're going to be there from 12 to 3 tomorrow. So, guys, if you have any questions at all for us, please feel free to reach out. Again, thanks for everybody who did reach out about my mom. And I would say this: give it a couple, like I say, 1 to 2 quarters. We're going to see rates come down, supply demand go up, and we're going to have a smoking economy coming up, and over the next 6 to 12 months.